It is Sunday evening, January 12th, 2026, and I'm watching something I have not seen in 12 years of tracking financial markets. The financial channels look calm, almost boring. CNBC is talking about technology stocks. Bloomberg is hosting another panel about economic resilience. The tickers are moving, green here, red there. Everything looks normal, and that is exactly what makes this moment dangerous. Because while the screens are calm, the physical metals market is not. I am David Kim, and I built this channel for one reason: speed. I'm not interested in waiting 12 hours for mainstream media to notice what is already happening inside the system. And I am not interested in the endless wave of channels pushing hype instead of structure. I focus on mechanics, stress points, and failure modes, and right now something has snapped. Over the weekend, the Department of Justice quietly launched a criminal investigation into Jerome Powell, the chairman of the Federal Reserve. Not a procedural review, not an ethics committee warning, but a real criminal probe tied to his 2024 congressional testimony and suspicious renovation expenditures at the Fed. The media is trying to frame this as background noise, as politics, as a temporary distraction, but the physical silver market just delivered a very different verdict. American Silver Eagles, the benchmark 1-ounce coin, just crossed $100 at major dealers across the United States. Not the spot price, the real price, the price you actually pay to get metal in your hand. While the screen still says silver is in the mid-80s. And this is not a glitch, not a spike, not a coincidence. It is a regime change. For the first time in modern financial history, the institution that controls the money printer is under criminal investigation by its own government. And the physical market is responding exactly the way a rational system responds when trust breaks. Here's the core reality. The DOJ investigation has shattered the illusion of Federal Reserve independence. The loss of trust has triggered a global flight into hard assets, and that flight has caused the physical silver market to decouple from the paper market. We are no longer trading a metal, we are trading a confidence crisis. A few hours ago, gold printed a new all-time high above $4,600. Silver spot closed in the mid-80s after a massive move. But when you go to real dealers like APMEX, JM Bullion, SD Bullion, the price of a basic silver eagle is no longer in the 90s. It is 100. Some are listing 102, some 105, and smaller dealers are even higher because they cannot restock. Think about what that means. The paper price says 85. The physical price says 100. That is nearly an 18% premium. In a normal market, premiums are $3 to $5, maybe $8 when supply is tight. 18% is not tight supply, 18% is a divorce. This is what I call the premium gap, the separation between the paper market and the physical market. And once this gap opens, it rarely closes quietly. The spot price you see on financial websites is not the price of silver, it is the price of a futures contract, a paper promise. Most of these contracts never result in delivery. They are closed, rolled, or settled in cash. Physical silver is different. It has to be mined, refined, minted, shipped, stored. It has mass, it has friction, and most importantly, it has limits. Think of it like a concert ticket. The official price might be $85, but if the show is sold out, that number is meaningless. The real price is whatever the last ticket changes hands for outside the stadium. And right now, the stadium is sold out. The $85 price is a ghost. The real price is $100. And here's the trap. When the paper price dips, people think silver is getting cheaper, but the dealer price does not follow because the dealer does not have inventory. The paper market is still playing casino games. The physical market is in rationing mode. That is not a bull market. That is a trust event. I have contacts at mid-sized dealers, and one of them told me his weekend order volume was 4 times normal. People were buying anything they could get, eagles, maples, generic rounds. They were not speculating, they were evacuating. And that is the difference. When people buy because they want exposure, that is a trade. When people buy because they want possession, that is a system stress signal. There is also a rumor circulating in institutional circles that a major London vault is facing a delivery problem, that a large entity demanded physical metal, and the metal is not there. I cannot verify it, but I can tell you it fits the price action perfectly because the entire structure is built on fractional backing, more claims than metal, and when someone calls the bluff, the only possible outcome is repricing. That is why the premium is exploding. Institutions are trying to secure physical supply. Retail is trying to front-run that, and the supply is finite. We are not watching a rally. We are watching the beginning of a structural fracture in the monetary system, and the DOJ just hit the system at its most sensitive point, credibility. Once credibility is gone, price discovery becomes violent, and this is only the beginning. To understand what is happening, you need to accept one simple fact. There are now 2 silver markets, and they are no longer the same thing. There is the paper market and there is the physical market. The gap between them is no longer theoretical. It is now visible in every dealer inventory screen. The paper market is COMEX, futures, contracts, leverage, netting, and settlement games, most of which never touch metal. The physical market is inventory, delivery, logistics, storage, and finite supply. In a healthy system, these two markets track each other closely, but in a stressed system, they separate. And once that separation begins, it rarely ends quietly. This is exactly what we are watching now. Let us run the numbers. The premium gap is currently around 18%. If spot silver goes to 100 and that gap stays the same, physical silver becomes 118 to 120. That is the conservative scenario. Now, stress test it. In previous commodity crises, physical premiums have reached 40 to 60%. If that happens here and spot silver is 100, physical silver becomes 140 to 160. You will be paying 150 for a coin while your screen says 100. And that is not theoretical. That is how rationed markets behave. Now look at the technical indicators. The RSI is above 77, which in a normal market means a pullback is coming. But this is not a normal market. Dealers cannot keep inventory. That means the buying is not speculative, it is defensive. Here's another anomaly. The dollar index is holding, gold is at all-time highs, and silver is exploding. That combination should not exist in a textbook world. Unless this is not a currency trade, unless this is a trust liquidation, money is fleeing into anything that is not a promise. That includes dollars, but it also includes metal. This is what liquidity stress looks like before it becomes visible in equities. Now let us talk about what the system always does in moments like this. COMEX raises margin requirements. It always does. That forces leveraged traders to sell, the price dips, and the media declares the rally is over. But here's the trick. The physical market does not care. The paper price can fall to 80, and the dealer price will still be near 100 because the supply is not there. This is the trap most people fall into. They watch the screen and ignore the shelves. Another indicator I am watching is the gold to silver ratio. Right now it is in the mid-50s. Historically, when it breaks below 50, silver enters a mania phase. That is when premiums go insane. That is when retail panic buying begins. That is when governments start paying attention. And that is when rules start changing. Which brings us to history. In 1980, when the Hunt brothers tried to corner silver, the exchanges changed the rules, banned new long positions, hiked margins, forced liquidation, and silver collapsed. But there's a critical difference. In 1980, the buying was concentrated. In 2026, the buying is decentralized, global, and driven by fear of the system itself. You cannot ban that. You cannot regulate that away. You can only try to manage the symptoms, and that usually makes things worse. There is also the geopolitical layer. China and Russia have been accumulating metal for years. If they smell weakness in the Western monetary system, they will accelerate. Silver is not just an investment metal, it is an industrial metal used in solar panels, electronics, medical devices, and military systems. If governments decide it is strategic, supply disappears overnight. And supply is already inelastic because most silver is a byproduct of other mining. You cannot just turn on new production. That means price does the rationing, and price can go much higher than people think before behavior changes. The middle class cannot buy gold at 4,600, but they can buy silver at 100. That is why silver becomes the pressure valve in monetary crises. And that is exactly what we are seeing now. This is not about making money. This is about exiting trust-based assets. And once that process starts, it does not stop quickly. If you think what is happening in silver is chaotic, you have not studied how the system reacts when it starts losing control of price discovery. There is a playbook, and it has been used before. The first move is always the same: raise margin requirements. When COMEX raises margins, leveraged traders are forced to either add cash or liquidate positions. Most cannot add cash, so they sell, the paper price drops, and the financial media immediately declares the rally is over. This is not an accident. It is a pressure valve designed to shake out weak hands and restore narrative control. But here's the problem this time. The physical market does not care. You can crash the paper price and it will not magically create inventory. Dealers will still be empty, premiums will still be high, and the real market will keep trading at a different level. The second move in the playbook is position limits. The exchange claims it is preventing manipulation. But the real goal is to stop large players from demanding too much metal at once. A single silver futures contract represents 5,000 ounces. If a fund holds 10,000 contracts, that is 50 million ounces. If the vaults do not have it, you have a crisis. So the exchange caps positions, not to protect fairness, but to protect solvency. Watch for this, because when position limits appear, it means the system is under stress. The third move is narrative warfare. The media will start calling silver a bubble. They will compare it to meme stocks. They will bring on analysts who say retail is being reckless. The goal is psychological, not analytical. They want to break conviction. They want people to sell into engineered weakness. This is exactly what happened in 1980 during the Hunt brothers episode. when the rules were changed mid-game and silver collapsed. But this time, the structure is different. In 1980, the buying was concentrated in a few hands. Today, the buying is global, decentralized, and driven by distrust of institutions. You cannot bankrupt 1 billion small buyers the way you can destroy 2 big speculators. That is the structural difference that makes this situation much more dangerous for the system. Now, let us talk about the political layer. The DOJ investigation into Jerome Powell has created an impossible situation for the Federal Reserve. If the Fed hikes rates aggressively, it risks crashing markets and exposing stress everywhere. If it cuts rates, it looks like surrender and confirms that the system is out of control. If it does nothing, inflation and credibility continue to rot. This is what a policy trap looks like. There's also an unverified rumor circulating that the Fed could attempt what I call hike to spite, raising rates not to fix inflation, but to deliberately create a downturn and demonstrate that political interference is dangerous. I do not know if this is true, but the incentive structure exists, and that alone should worry you. In any of these scenarios, uncertainty increases, and uncertainty is fuel for hard assets. Now consider another angle. What if the government decides silver is strategic? Silver is critical for electronics, energy infrastructure, and weapon systems. In a geopolitical crisis, access to silver is national security. If the Treasury announces a strategic metals reserve and starts buying, you are no longer competing with investors. You are competing with a sovereign entity that can create unlimited currency. That is game over for the supply side. Even the hint of such a policy would send prices vertical. On the supply side, nothing can respond quickly. Most silver is mined as a byproduct of copper, lead, zinc, and gold. You cannot just double silver production because the price doubled. New mines take years to permit and build. That means demand shocks go straight into price. This is why silver historically moves in violent bursts rather than smooth trends. It stays quiet for years, then it reprices in months. Now let us talk about psychology. When silver's at 30 or 40, nobody cares. When it is at 100, people start paying attention. When it is at 150, it becomes political. That is when you get emergency meetings, regulatory interventions, and narrative panic. That does not mean the move is over. It means the system is scared. And scared systems make mistakes. Another risk that rises with price is counterfeiting. The higher the price, the more incentive to fake coins and bars. This is why buying from reputable dealers is not optional. It is mandatory. The last thing you want is to discover your metal is fake when everyone is trying to sell. This is not theory. It is already a problem in gold, and it is coming to silver. All of this leads to one conclusion. This is no longer a normal market. This is a confidence war. The paper market is trying to maintain control. The physical market is exposing the limits of that control, and the political system is injecting instability at the worst possible moment. You do not get smooth outcomes from that mix. You get volatility, rule changes, and sudden repricing events. And once a system enters that phase, it does not go back to normal quickly. The only question is not whether the price moves, but how violent the path becomes. At this point, the most dangerous mistake you can make is to think in terms of normal markets. Nothing about this environment is normal. When the credibility of the central bank is questioned by its own government, when the paper market loses control of price discovery, and when physical supply becomes scarce, you are no longer in a cycle. You are in a regime change. The only rational response to a regime change is to stop trusting old models and start thinking in conditional logic. If this happens, then I do this. If that happens, then I do something else. That is how you survive periods when rules are rewritten in real time. My personal framework is simple. I do not buy the ghost price. I do not make decisions based on what the screen says. I watch availability. If inventory disappears, price becomes irrelevant. You either have the asset or you do not. If the DOJ investigation ends tomorrow and Powell is fully cleared, I expect a short-term dip in metals as the market interprets that as resolution. Not because the system is fixed, but because uncertainty temporarily decreases. If the Fed responds to this crisis with aggressive rate hikes, I expect chaos in equities and real estate and continued strength in hard assets, because that would signal desperation, not control. If the Fed cuts rates, the message will be even worse. It will look like surrender, and the flight to tangible assets will accelerate. In other words, the Fed is trapped, and markets can feel it. That is why volatility is not a risk here. It is the base case. That is also why I do not try to time the core position. I separate my thinking into 2 layers. The core is insurance. The edges are tactics. The core is not for trading. It is for surviving a monetary accident. The edges are for taking advantage of volatility, trimming into strength, adding into engineered weakness, and rebalancing into other real assets when ratios become extreme. One ratio I watch closely is the gold to silver ratio. If it drops to 50 or below, that tells me silver has entered a speculative phase relative to gold, and I will rotate part of that exposure back into gold, not because I am bearish on silver, but because I respect mean reversion and risk management. Another rule I have is premium discipline. If physical premiums exceed 25% and spot does not confirm, I stop buying. At that point, you're paying a panic tax, and panic taxes are almost always temporary. I would rather wait for compression or for spot to catch up. The third rule is support behavior. If spot revisits the low 80s and holds, that tells me the structure is strong. If it breaks and fails, I reduce exposure, not because the long-term thesis is dead, but because I do not fight momentum. This is not about being right, it is about staying solvent. I also think about political risk. In extreme scenarios, governments do strange things. They impose capital controls, they restrict exports, they change tax rules, they may even talk about strategic reserves or emergency powers. None of this is my base case, but it is in the distribution. That is why diversification still matters. Silver is a hedge, not a religion. I also hold gold, some cash, and real assets. The goal is not to guess the future perfectly. The goal is to not be wiped out by a future nobody can predict. There is also a psychological battle coming. The media will try to exhaust you. They will alternate between panic and ridicule. One week, silver is a bubble. The next week, it is irrelevant. The week after, it is a dangerous speculation. The purpose is not to inform you. It is to destabilize your decision-making. You need to decide in advance what game you're playing. If you are a trader, trade, use stops, take profits, accept that you will be wrong sometimes. If you are a holder, then hold and stop watching the screen every day. You cannot claim to be hedging against systemic risk and then panic over 10% moves. That is not a strategy. That is emotional noise. For me, this is not about making more dollars. It is about owning things that are not someone else's liability. If the dollar survives and everything stabilizes, fine. Metals underperform, and I still have a diversified portfolio. If the system continues to fracture, I am not standing there holding promises. That is the asymmetric bet. Now let me end with the big picture. The DOJ did not just investigate a man, it cracked an institution. The Federal Reserve's power has always been based on perception, the perception of competence, independence, and control. Once that perception is damaged, markets do not return to sleep easily. The physical silver market is not screaming because of speculation. It is whispering because of fear. And fear moves slower at first, then all at once. The screen can say 85. The dealer can say 100. The dealer is not lying. The screen is showing you a model that is breaking. The premium gap is not a glitch. It is the price of certainty in a system that is losing credibility. You're not watching a rally. You are watching the early phase of a repricing of trust itself. And those moves, historically, do not end quietly.